point in time, we would like to get started with the annual forecast. First, we're going to have Mark Fitzgerald, our president, come up. Mark started at High in 1989 as a commercial property manager. During his career at High, he has been successful at several leadership titles, and in July of 2012, he became the president and COO of the High Real Estate Group and High Associates Ltd. In his role, he oversees and manages over 10 million square feet of commercial industrial space with, now I know this number is wrong, over 2,000 apartments, I'll say over, 600,000 square feet of retail space and 13 hotels. He is a graduate of the Wharton School at the University of Pennsylvania. He is a licensed realtor, a CCIM, a CPM, and is a registered representative of the National Association of Security Dealers. Outside of his responsibilities at High, he is currently on the board of directors at the Fulton Opera House, the EDC, Lancaster City Alliance, and the Bank Creek Country Club. And Mark Fitzgerald, everyone.
I know Brian already started off by thanking the staff at the Convention Center. They did a great job. I'd like to start off by thanking all of you for showing up this morning. We were a little worried last night when we were watching the weather reports, and it said we get up to 6 to 12 inches, and a little concerned about who's going to show up today. My team puts a tremendous amount of work in putting this presentation together, so I know it's greatly appreciated when we see a packed house. So with that, we'll start with the presentation. Okay, I'm going to start with a little bit of the audience participation question. And the question is, the Dow is down 8% so far this year, and 12.5% from its 52-week high. How many people think we're in a market correction? And how many people think we're heading into a recession? By show of hands. So market correction, heading into a recession. Okay. All the bankers raised their hand for a recession. Well, everybody raised their hand. I think this is a market correction. I think everything that I've been able to read would indicate that at least for the U.S. economy, we're on pretty strong footing. If you look across the spectrum of consumer confidence, employment, wage growth, people are feeling good about their prospects. If you look at corporations and you look at their balance sheets, you look at their cash flow, they're having record years. So I think things bode well for the corporations. And the federal government, I think there's no end to the money that they can spend. So I think if you put all of that together, there is a tremendous amount of opportunity for additional GDP growth. So if we look at the numbers and we look at kind of where we ended 2015, as we entered into the fourth quarter of 2015, it was feeling like a pretty good year. I mean, we were averaging about 2.2% growth in GDP. Not great, not anywhere near its historical norm of about 3.25%, but still, since the recession started, it was better than previous years. And then all of a sudden, the fourth quarter came along. And we took a pretty big hit, only 70 basis point improvement in the fourth quarter. So when you average all that out, we ended up at about 7.8%, which just coincidentally happens to be almost exactly the average since the beginning of the recovery, 7.78%. So, you know, it's starting to feel like 2 is the new normal for 3. And I don't know if that's something that we're going to see long term, but clearly that's the type of growth that we've seen since the beginning of the recession, or it's the end of the recession, I should say. If you look at 2016 going forward, as I started to kind of prepare for this talk and started reading all the information that we received from the banks, and you start getting this stuff earlier in the year, everybody was talking about a 2.5% growth for 2016. I don't think I can find any economist today that is projecting growth in excess of 2%. So from our perspective, we're looking at about 1.75 to 2% growth in 2016. Consumer price index, this is good news, has been very, very flat, under 1%, coming in at 70 basis points. We think it's going to remain about there, maybe tick up slightly, because I'll talk about it in a second. We're absolutely starting to see pressure on wages, and that will have an upward tick on inflation. Right now, that's being offset by a precipitous drop in oil prices, so those things are balancing out a little bit, but I think eventually you're going to start to see the impact on inflation with increased wages. If we look at employment or unemployment, it's a very good picture. If you look at where we started the year, 5.7%, on the national level, we're down to 5%. Back when I went to school, that was called full employment. So we're continuing to project that employment will hover, or unemployment will hover around 5%. And I think the more interesting thing to think about on this particular slide isn't the unemployment rate. I think it's the labor participation rate. I think that's the more important issue that we've got to look at. And right now, we're at about a 40-year low. We're about 62.7% participation. That's down almost 5 points from its high in 2000. That represents about 15 million people. 15 million people that have left the workforce. So my hope is that we start to see that employment come back in. I think that will keep the unemployment rate around 5% and maybe diminish a little bit the pressure on wage increases. If you look at the 10-year treasuries, what a difference a month makes. We put these slides together at the end of the year and 10-year treasuries were at 2.27%. We woke up this morning, I think they were 1.72%. So that's a 50 basis point drop. That's incredible in 30 days. We'll talk about why that is in a moment, but that's a great thing if you're a borrower. It's not a great thing if you're a lender right now. Okay, so some of the national drivers. We talked about this last year, tremendous amount of instability globally. You've got problems in the Middle East, you have ISIS, you have, for the first time that I can remember, China reporting GDP growth of 6.9%, under 7%. Their 25-year norm has been close to 10%. So that is a significant drop in their GDP growth numbers. And some believe that the actual numbers are significantly below what they're reporting. So what does that mean for us and what does that mean for real estate? I think it's been very good news for the U.S. in terms of both real estate and treasuries. U.S. continues to be the safe harbor to the world. We continue to see a tremendous flight of equity into the U.S., both buying real estate and investing in our U.S. treasuries. I think as a result of that, you're seeing that precipitous drop in U.S. treasuries. If we look at oil, an unbelievable drop. 75% drop in 2 years. 2 years ago, oil was at $110 a barrel. Today it's under 30. That's incredible. So some of that has to do with OPEC continuing to keep the supply high, and some of that has to do with demand for oil down. So where that all shakes out, I don't know. But I do know that right now it means additional dollars in everybody's pocket. And I know Lynn Good and I had a big debate yesterday about is that good for the economy or bad for the economy? I won't tell you the side that Lynn took, but I took this side that it was good for the economy. And he argued the other side vehemently, so last night I went home and I did some more research. And I gotta say, I don't know, Lynn might be right this time. But I said it and it's on record, it's on film. Historically though, a drop in the oil prices has been good for the economy because $1 more in our pocket has a bigger impact on the overall economy than $1 more in the oil producing company's pocket. Okay, it's the multiplier effect. It has a bigger overall impact on the economy. Today though, I'm not sure about that. So definitely you're going to see an increase in consumer spending. Some of that money may go to pay down debt, and I think there's been a tremendous amount of that on the personal side. But now you're starting to see the potential, because of that precipitous drop, it could start having an impact on the financial institutions based on their exposure to the oil-producing companies. And it could also have an impact on capital investment. So I'm not sure that the jury's out. I think the jury's still out on that one yet. I still think it's going to be net positive. And if you look up here, this was an amazing statistic. For every 1 cent drop in a gallon of gas at the pump generates $1 billion of additional GDP growth. I think that's amazing. Corporate profits continue to be at an all-time high. And the other thing I pointed out, and I was talking to Marilyn Berger here a moment ago, and she's saying she's having just an incredible year in 2015 and continuing into 2016. Consumer confidence is at an all-time high since the recession. So I think all those things bode very well for the real estate business. Real quick, I'll dive a little bit deeper later on in the presentation on each one of these, but I just wanted to talk real quickly. Apartments. I think apartments may have hit their peak, certainly in some markets where we're starting to see some overbuilding, but there's strong demand for infill and mixed-use developments. On the industrial side, this is the hottest asset class out there today for both lenders and institutional investors. And I'll talk a little bit more about why that is later. If you look at hotels, hotels have seen a tremendous recovery since the beginning of the economic recovery. If you look at the RevPAR growth, that's a combination of occupancy growth and rate growth. It's actually doubled the growth in GDP. And I think that's extremely positive for those of you in the room that own hotels. Unfortunately, I think that rate of growth will start to decline as we move forward, as there's been a tremendous amount of additional supply starting to come into the market. So I think that'll soften that growth going forward. CBD, the downtowns are back. They are strong as ever. Occupancy for first-class office space in the CBD is at an all-time high and growing 300 basis points higher than what we're seeing in the suburban markets. And then suburban market, I think there's a little bit of a silver lining here. It's a slow recovery, but I would say it's an accelerating recovery. We're certainly seeing it within our portfolio, and I think you're seeing it across the nation. Okay, here are just a couple of things to point out real quickly. If you notice on the arrows on the change, every single one of the cap rates for every single one of the asset class saw compression in 2015. So we're looking at numbers up here that are absolutely incredible. 5% average cap rate for apartments, 5% for industrial. These cap rates are just incredible. I think we'll continue to see some of them, industrial, maybe tick a little bit lower in 2016. I think apartments may flatten out, and in some markets you might even see a little bit of a bump in those cap rates. But again, real good news story. If you're a seller, you're selling at the optimal time right now in the marketplace. A couple of things to point out on this slide, and I think these are two really interesting points. With the exception of multifamily, supply growth has been kept in check. And I was talking a little bit to Tom earlier about the constraints that the banks have on lending for new construction. I think those constraints have kind of kept a governor on additional supply coming into the market, and that's allowed us to keep our market relatively in balance and if not improving. The other thing that I thought was really interesting is if you look at every asset class except retail, the occupancy rates in 2015 were above their 20-year average. I thought that was pretty impressive. So it definitely shows you we are in an improving market across the board. And then lastly, just a tremendous amount of equity out there. There's just a tremendous amount of cash looking for a home in all of the sectors, core plus, and value add. Okay, let's dive a little bit deeper into each one of the asset classes. Industrial, it's not sexy, but it's very attractive. It's a great asset for cash flow stability. It's a great asset for minimal volatility. It's a great asset for limited capital investment. So this asset class is certainly attracting a lot of attention. Occupancy is down, and if you look at the absorption, look at what I talked about, you'll see this on each and every slide. We show you the net new construction and then the total absorption. So in this case, you looked at about 12% positive absorption. So the market absorbed 12 million square feet more than was delivered in 2015. So that's a good thing. Effective rents are increasing for existing space at about 2.9%, for new space at about 5.4%. There is a robust pipeline, so this is one we've got to watch and make sure that we don't get to an overbuild situation. Okay, what's driving this? And we talked about some of the things that are driving this. And I think one of the things that I found, that we'll talk about a little bit more in the retail section later, but the US is really an economy of consumption. And a couple of interesting statistics that I have up here. In 1960, 60% of the GDP of the US went for consumable goods. In today, you're looking at 70%. That's an enormous increase. So that increase in consumption is driving an increase for goods and services and products, and you need warehouse space to accommodate that. So I think that's been a very positive thing for the industrial sector. If you also look at the growth in retail sales, so since the recovery started, growth in retail sales is 2.4%. GDP is 1.78%. So that sector of the economy continues to grow at a faster pace than the overall economy. Again, creating a demand for the industrial space. If you look at technology, everybody talked about what impact was e-commerce going to have on real estate. I'll talk about it on what impact it's having on the retail side, but it's having a positive impact on the industrial side. So it's actually been a positive disruptor for the industry and increasing the need for warehouse space, and not only the big box warehouse space that we've all seen, right? The 1.5 million, 2 million square feet of space. But now that space is being driven down to that last mile. So really looking for 50, 75,000 square feet of space closer to the customer. And I think you'll see that demand continue to increase going forward. So where are we in the cycle? Very positive. If you look at 2014, we were down at a 5. 2015 on a national level, we moved up 3 points to an 8. Again, it could be higher up in the scale. I think as we go forward and we look at that additional speculative development that's going to occur, that'll push us up to the top. The other thing that we did this year, we've not done this before, but the team and I kind of looked at Lancaster. And we tried to look at all the factors, and we put, for the first time, we put where we think Lancaster is on this scale. And we put Lancaster at a 7. Clearly we're seeing rates increase, we're seeing occupancy improve, but we're not seeing that speculative development occur yet. So we're not deep into the recovery, but we're certainly in that expansion phase. If we look at suburban office, we continue, the slow recovery, but as I said before, I think it's accelerating. Office employment, this is great news. Last year I couldn't say this year I can. Office employment is above the pre-recessionary levels, so that's a good thing for demand for office space. Again, very limited new supply, only 16 million square feet of new supply, but 32 million square feet of absorption. So that bodes very well for the asset class. Rents are starting to go up, and the other thing that I found very interesting is that 21 consecutive quarters of rent increases. Now, albeit they might have been small rent increases, but we've got a very positive trend for suburban office space. The other thing that's interesting is both investors and developers are starting to focus on 18-7 cities. We talked about this last year, maybe 2 years ago, that trend's starting to move from the 24/7, where there's been just a tremendous amount of capital flooding into those gateway cities, the Salty Six, they like to call them. But now we're starting to see, because of cost, we're starting to see more and more investors and developers look at the 18-7, looking at Atlanta, looking at Charlotte, looking at Nashville. It's those markets, better quality of life, more affordable housing is starting to attract those lenders and investors. So the office drivers, I felt this was very interesting. TAMI is replacing FIRE. And for those of you that don't know what TAMI is technology, advertising, media, and information. And I want to stress the information component. I'm sure all of you have IT departments back at your companies. There's been an incredible growth in the IT sector and a reduction in the administrative sector. So we're starting to see a shift in how that office space is being used. which I think is very interesting. The other thing that we've started to see, and we talked about this for the last couple of years, you heard me talk about a statistic, 225 square feet per employee. That used to be the old rule of thumb for developing space. And then it started moving down to 200, then it started moving down to 175 and 150. And I think we may have hit bottom, and I think employers are now looking not so much at how many people can I squeeze into my floor plan, I'm looking at the productivity of those employees. So can I create an environment where I get more output from the employees and not necessarily just cost containment? So I think that's changing how we're designing our space. Instead of just wide open spaces, we're looking to have a combination. Open spaces, collaborative spaces, private spaces, and semi-private spaces. So I think that's a trend that we'll continue to see. Hip and cool, not just for the startups. And I'll give you a personal note here. There's a lot of adjectives that are used to describe high. I don't think hip and cool is one of them that I've heard. But we just eliminated 4 cubicles in our office, and we are constructing kind of an open collaborative meeting room where people can come together and congregate. So we're changing the space to kind of meet the needs of what the market is asking for today. So we'll see how that works out. Okay, so with all that positive news, we really haven't seen much movement in the sector. It's still down in the recovery phase. I think as we look into 2016, we might cross the barrier and get into the expansion phase. If we continue to see limited supply growth, keep the demand up, I think you'll start to see some new speculative construction maybe coming back in that sector. Certainly in the markets that I talked about, the 18-7 cities, you'll see some additional construction there. Apartments. Deja vu or a new paradigm. And this is something that I think has been getting a tremendous amount of press. I'll tell you, there's a lot of debate about this in our office. Have we seen a secular shift from the desire to own homes? And are we migrating toward a more renter population? I put up some statistics here. So if you look at the national home ownership rate for 2015, December of 2015, 63.7%, down about 70 basis points from the previous year. The Northeast a little bit lower at 61.6%. But here's the part that I thought was interesting. And I broke down the averages. I went back and I looked from 1960 when they started collecting this statistic all the way through to 2000. And the average for that period of time was 64.3%. So if you see, we ended 2015 very close to what that historical average has been. If you look at what happened from 2000 to 2015, home ownership rates increased to 67%. So was that a function of a shift in people's desire to own homes, or was that a function of capital availability and the ability to get mortgages, to buy homes? If you didn't have an income, you didn't have to qualify, all the things that led to the Great Recession. So I'm not sure I know the answer to that question. But I think one of the factors that will really decide if there's been a permanent shift or if this is just a cycle that we're going through is the millennials. And ultimately, where will the millennials land? And so ULI did a study, and they asked this question of, and I don't recall the number of millennials that they asked, but they asked the question, where do you currently live? And 46% said they live in the city. And then they asked the question, where do you want to live? So in the next 5 years, where do you think you're going to live? And 9% said they wanted to move to the suburbs. On the converse, 24% said they currently live in the suburbs, and only 5% said they wanted to move to the city. So the question is this big push into the city and this big push into rental just a deferment of the American dream of owning a home, or is it permanent? And I don't think we have all the information yet on that, but it's something that we've got to watch, and we'll see what happens as time unfolds. So from my perspective, what's the perfect future? So if I were looking at developing a development strategy, which is one of the things that we do at High, I would say kind of the perfect future for me would be a suburban urban infill location. So you're looking at a property that is within 20 to 30 minutes to the downtown. So you have convenient access into the downtown to take advantage of employment, entertainment, restaurants, activity, all the great things that happen in great cities. You're in a mixed-use development. It's walkable to retail and office. It's close to mass transit. Walkability and mass transit are key issues going forward, and access to good schools. So if you look at kind of multifamily development going forward, I think you're going to see a lot more projects that kind of meet these criteria, which is that blend between the downtown city and living in your parents' suburbs. I think there's going to be a different mix. So the good news is, despite all the additional development that has occurred in 2014 and 2015, vacancy rates at an all-time low. So the demand continues to be there and absorb the additional product that is coming online, and rents continually go up. So if you look at where we are in the cycle, on a national basis, I think we're pretty much at the peak. And if we don't see that increased demand for rental and the supply continuing to go, I think in certain markets, we will certainly cross over and get into the hyper supply stage. In Lancaster, I still think we're in the expansion phase. We've seen very, very solid rent growth. We've seen very, very solid occupancy. We have not seen a tremendous amount of new construction yet. A lot of projects on the docket, a lot of projects in the pipeline. It hasn't come to fruition yet, but when it does, we'll certainly see some movement on that scale. Retail, grocery-anchored retail centers continue to remain the preferred asset class in this space. We've got solid rent growth, occupancy 93.5%, so very, very strong. One of the things that I think would surprise most of the people in this room is retail actually outperformed all other asset classes in terms of total return in 2 of the last 3 years. And if you look at a 20-year horizon, on a risk-adjusted basis, retail actually generates the highest return of all the asset classes. So despite all the press that you see about the doom and gloom on retail, it continues to be a very attractive asset class for investors and developer alike. Tenant mix continues to change. Restaurants and entertainment are key. It's all about the experience. If you're going to a property, it's not about buying the stuff. It's about the experience that you have when you get to that property. Seeing a great deal of success at the barbells. So either at the value end of the equation or the luxury end of the equation, those retailers are doing extremely well, and centers that are anchored with those tenants are doing extremely well. If you're in the middle, it's very, very competitive there. And the other thing that we've been talking about for a long time is, what is the impact of e-commerce going to have on retail? And I think as we've kind of seen the emergence of e-commerce to where we are today, there's a real blend that's occurring between the online retailers and the traditional bricks and mortar retailers. And they're starting to converge to a more omni-channel. I'm sure all of you have seen that Amazon is actually opening up their first store in Manhattan. So they're the behemoth online retailer. They're opening up their first store, and I think they announced that they're actually going to open up 20 more across the nation. So you can see going more toward an omni-channel solution. E-commerce is up to about 9% of total sales, which has been a pretty rapid growth from 0 to 9% in a relatively short period of time. The question is going to be, can it go from 9% to 20%? I think that's going to be a much harder hill for them to climb. If you look at where we are on the cycle, I think Lancaster, pretty good right now. Very strong occupancies, very, very good rent growth. But again, I think there's a lot of projects that are in the pipeline. As all those projects come to fruition, we potentially could find ourselves in a hyper supply situation. Okay, looking real quickly at the underwriting criteria, this continues to be just a great story if you're a borrower. This slide, again, it's only 30 days old, and it's outdated. If you look at where we had treasuries pegged at 215, today at 172, I think you're looking at 10-year fixed rate financing, definitely in the low 4s and down in the high 3s is what you're looking at for existing properties. Low loan to value, great time to be a borrower. Okay, and with that, we'll turn it back over to Brian, and he'll turn it over to Michael. Thank you.